Today, we're really getting into the UK's financial landscape, looking at some of the big forces shaping its economic future. Our guide for this is the Office for Budget Responsibility's latest report, the Fiscal Risks and Sustainability Report, from July 2025. It's meant to be an independent look at the UK's long-term financial health, and our mission is to pull out the key insights for you, cut through the hundreds of pages, and give you a clear picture of the challenges and maybe opportunities ahead. The OBR doesn't exactly pull its punches. The starting point is a pretty vulnerable picture of where the UK stands right now, fiscally speaking. What's really striking is how we compare internationally. The UK deficit at the end of 2024 was 5.7% of GDP, significantly higher than the average for advanced economies, putting us in the top 5 highest globally. Then there's government debt at 94% of GDP, again, one of the highest. Plus, our borrowing costs are relatively high too, with the 10-year bond yield at 4.5%, the third highest. The report suggests a lot of this vulnerability comes from debt piling up over the last couple of decades, up by 60% of GDP, mainly because governments kept reversing plans to cut spending or raise taxes. That definitely sets a concerning scene. But here's where the OBR really focuses its attention in this report. It zooms in on 3 main areas of risk: pensions, the public sector balance sheet, and climate change. These are the forces that are really going to shape things for years to come. Let's unpack the pension system first. The scale here is just enormous. The state pension is the government's second biggest spending area. We're talking £138 billion, or 5% of GDP, just in 2024-25. And then private pensions, people's savings pots, add up to £3.2 trillion. That's actually more than our annual GDP, at 114% in fact. It's the second biggest asset households have, after their homes. Internationally, the UK system is a bit different. We rely more on that private pension income than many other countries. In principle, that might shield public spending a bit from an aging population. But there's a catch. It creates indirect risks. If those private savings aren't enough for people in retirement, they might end up needing more state support anyway, through means-tested benefits or housing support. We've had some big reforms lately, like the state pension age going up and the new flat-rate pension. But the really dramatic change on the private side has been automatic enrollment, where you're automatically put into a workplace pension unless you actively opt out. This has pushed participation way up, from only 42% of private sector workers in 2012 to 86% in 2023, a huge jump. Despite this, the OBR still flags 3 major pension risks. The first is the direct cost of the state pension. This is driven by demographics. The number of working-age people for every pensioner is set to fall from about 3.4 now to just 2.7 by the early 2070s. We're living longer, with life expectancy at birth potentially hitting 94. That demographic shift alone is forecast to add 1.6 percentage points of GDP to state pension spending by the 2070s. But it's not just demographics. The triple lock mechanism guaranteeing the state pension rises by the highest of earnings, inflation, or 2.5%, has actually cost about 3 times what was initially expected. The original forecasts didn't anticipate the kind of volatility we've seen in inflation and earnings. The OBR now projects it will add an extra £15.5 billion a year by 2029-30. If that volatility continues, the triple lock could add another 1.5% of GDP to spending by the 2070s. The rising state pension age helps, but it doesn't solve this underlying pressure. The second pension risk is the flip side: inadequate private savings. The OBR points to a few key groups. Low earners, private renters, nearly half are projected to miss retirement income targets, and the self-employed, whose pension participation has dropped dramatically from 35% down to just 18%. If these groups fall short, it could mean more claims on means-tested benefits or needing help with social care costs down the line. a direct fiscal cost. The third pension risk is a bit more technical but important. It's about the decline of old-style defined benefit pension schemes. These schemes were traditionally big holders of UK government debt, or gilts. As they're replaced by modern defined contribution schemes, which operate differently, the OBR projects the entire pension sector's demand for gilts will fall significantly by almost 2/3 by the early 2070s. Less demand for government debt could mean higher interest rates for the government when it borrows, potentially adding £22 billion a year to debt interest payments. It's interesting they just gloss over the ballooning public sector pension liability, which is unfunded and relies on other workers' contributions to pay pensioners. These very generous schemes pay retirees a percentage of their salary depending on service and are inflation-linked for life. It's not uncommon for someone to retire on 2/3 of their final salary. Needless to say, these are few and far between in the private sector. This liability alone runs to trillions of pounds. If anything in the presenter's view is unsustainable, it's this. It's a form of pension apartheid. Now for the second deep dive area, the public sector balance sheet. In October 2024, the government adopted a new target measure, Public Sector Net Financial Liabilities, or PSNFL. It's broader than the old net debt measure. It includes not just government debt, but also liabilities from funded public sector pension schemes and a wider range of financial assets the government holds, like student loans. However, it importantly does not include the huge unfunded pension liabilities for the NHS or teachers, estimated at £1.4 trillion. Even with that omission, the government's financial balance sheet has ballooned, more than doubling as a share of GDP since the mid-2000s. This expansion brings new kinds of risks, particularly around how these assets and liabilities are valued. For example, a 10% fall in equity prices could add 1.3% of GDP to PSNFL. Changes in discount rates used to value future pension payments could add another 2.6% of GDP. There's also credit risk on government loans. The British Business Bank, for instance, expects 30–40% write-offs on its startup loans. And there's the risk of reclassification, where organizations like water companies or housing associations, which have huge debts, could be moved onto the public books, directly impacting the PSNFL figure. This all creates a potential incentive for government to use loans instead of grants, because it looks fiscally cheaper against the target, even if the loan is unlikely to be fully repaid. Finally, let's turn to the third major risk area, climate change. The OBR sees this hitting the public finances in two main ways: the cost of the physical damage and the cost of the transition to net zero. The projections for damage costs are quite sobering. Under a scenario where current global policies continue, the OBR estimates climate damage could knock 6% off UK GDP by 2050. That damage, through lower growth and tax revenues, could add a staggering 56 percentage points of GDP to public debt by the early 2070s. So the cost of inaction looks massive. But what about the cost of action? The OBR puts the total investment needed for the net zero transition at around $803 billion through to 2051. That is truly colossal number and just not feasible to support. Interestingly, about 2/3 of that estimated fiscal cost isn't direct government spending. It's lost tax revenue as we switch to electric vehicles and stop buying petrol and diesel. Fuel duty revenues are projected to dwindle to almost nothing by 2050. The other third is extra public spending on things like decarbonizing homes, upgrading transport, and developing carbon capture technology. The challenge is that current government spending plans already fall short of what the OBR assumes is needed. Policy choices here will have a huge impact on debt. A scenario with new taxes to replace lost fuel duty adds far less to debt than one relying purely on public investment. Bringing it all together, what does the OBR's overall risk register look like? Unfortunately, the general picture is worsening. Of the 50 specific fiscal risks they track, 12 have increased, while only 9 have decreased. Most of the new or increased risks are rated as medium or high impact. Technically, we are not broke yet. However, there is little room on policy choices, and the market is on the lookout for missteps and will price accordingly. Your savings deposit guarantee scheme will be worth nothing if the government runs out of cash. Then again, they can always print money and generate runaway inflation again, making your money technically worthless. This is all layered on top of that vulnerable starting position. And other pressures are intensifying. Geopolitical tensions pushing up defense spending, intensifying cyber attacks, persistently weak productivity growth, and relentless pressures on health and local government spending. The rise in working age inactivity due to long-term sickness alone could add £12 billion to welfare spending by 2029. Thanks for listening. Please continue the discussion in the comments, like and subscribe if you enjoyed the video.